MoneyWeb now. On the money.
I'm chatting with Ziad Saad. He's Principal Investment Consultant, NMG Benefits. So I'd appreciate the time. Some investment mistakes that folks make. You wrote a great article about some of them. The first one that pops up is waiting too long to start. And I think particularly when we're young, it's like, you know what, I'm in my 20s, I can start later. Truthfully, the earlier we start, the better. I mean, heck, starting as a teen is probably even better than in your 20s. The more time, the better.
First, good morning, Simon, and thank you for having me. And yes, look, I'm just going to give a very quick example. It's a question that somebody sometimes asks, what's the difference if I start today or next month? It's only 5,000 rands or 1,000 rands that I'm putting in this investment.
Yeah.
And one would actually not understand or underestimate the value of compounding. What this 1,000 rands or this 5,000 rands that you put this month, how much is going to be valued after 10 or 20 years? It depends on the investment journey. So the value of compounding, even the smallest amount, it actually adds up a lot and be substantial in the long term. So it's better to start yesterday, actually. And if you miss yesterday, then rather start today.
Correct. If not yesterday, then today. Don't leave it for tomorrow. One that really resonated me was not understanding returns. And you make a point. I mean, you do a 7% return and you think that you're the new Warren Buffett, but inflation's 5%, your fees are 2%, your actual return, your real return is zero. We need to look at the bigger picture, which includes costs and needs to include inflation to get that real return.
100%, Simon. I couldn't have said it better. It's very important because, every portfolio you are invested in has fees, and the financial service provider, they need to be exceptionally transparent about those fees. They need to be open about the hidden fees, and you must understand what is the total investment charges that these SPs are charging. And if you cannot get the net returns at least, which is actually the bottom line, the net returns is your returns after fees, and you have to have a little bit of basic knowledge about inflation and what it is, because at the end of the day, the purchasing power of your money has to actually at least be aligned to inflation so it doesn't lose its value. And that's why we look at the real return after fees and after inflation. And that is the real return. That is really how your money is growing from one year to another.
Yeah, that's your wealth creation. And then next was not matching goals with risks. And there's lots of moving parts here, but it really is understanding what you're trying to achieve and match those two. It can get maybe complicated. It might need some professional help here, but it's important that we get it right.
Simon, to your point, that is the most important thing, which is understanding what you want to achieve. How long will it take? When we look at risk, there are two things with risk. There is the willingness of taking the risk and the ability of taking the risk. And those two will depend on the time that it takes you to achieve your objective and what your objective is. And you need to align your investment to your objective. What that means is normally if your objective is a long-term objective, it means your ability to take the risk should be higher, because then the market will absorb that volatility over the long term, while it cannot absorb it on the very short term. And that's why those two have to go aligned together. Otherwise, you are in for some discrepancy in your investment journey.
Yeah, but you suddenly get to the other end and you've got the wrong product for what you needed.
100%.
Timing the market, I get the temptation when everyone's excited and markets are at highs, you want to be buying. When everyone's depressed and markets are falling, you want to be selling. Timing is a mug's game. The best thing we do is buy and hold, because getting it right is hard. I mean, I want to say it's almost impossible.
I would say, Simon, it's impossible, because if it was at all possible, you would have all your investment managers, billionaires until now. And look, I understand that timing the market, it comes from a certain panic in terms, but the best thing you can do is, like you said, buy and hold and absorb the volatility of the market, because when the market is rallying and when the market goes down, it rallies afterwards and compensates. I'm just going to give you a very quick example.
Yeah.
If you had invested 100 rands 20 years ago, you'll end up after 20 years with this 100 rands in the market, buy and hold, you will end up with 2,000 rands, let's say, after 20 years. Funny enough, if you have missed 5 of the best market days during those, not 10 years, 20 years, you would have ended up with 1,000 rands instead of 2,000. So you see, this is substantially adverse impact of trying to time the market, not let alone of you ending up buying high and selling low at the end at the same time.
Yeah, take your point. It's missing those good days, which they come along, and if you're not in there, well, you can't get that back.
100%.
Diversification, we get that. The other one I really like is reviewing your investments. Our life is changing. Our circumstances are different. I think we get lazy. We kind of fire and forget. We need to go back at least once a year, I suppose, and make sure that everything's still what we need.
That's very important, because remember, circumstances of the people change 1 year after that, and also the markets change. The markets change, so it's very important to revisit your investment at least on an annual basis, or when there are defining market events such as, the 2020 like COVID, or when there is a defining market event. It's important to review your strategy and review the risk involved. Just a very quick example, if I may. Now, nominal bonds in South Africa are considered like a kind of safe haven, they're offering high yields. But if there is any probability, and the probability is getting higher that the government, for example, is going to default on its bonds, then they're not safe anymore. And hence, you have to revisit your risk profile from that end to make sure that this is not a risk-free environment after all. This becomes risky. Not that it was risk-free before, but what I'm saying is it gets more risky when events like that happen. So, it's very important to revisit your investments on a yearly basis.
And I like that analogy, because the bond yields go higher and you think, ooh, this is nice. But of course, that's telling you the risk has changed. That's hugely important.
100%.
We leave it there. That's Ziad Saad. He's Principal Investment Consultant, NMG Benefits. Appreciate the insights.